Kaspi.kz's full year 2025 results reveal a highly optimized platform standing at a pivotal frontier, extracting maximum yield from a saturated domestic monopoly while financing an aggressive, high-stakes ecosystem transplant abroad. Consolidated revenue surged by 60% to $4,046 billion. But reported consolidated net income expanded by only 1% to $1,068 billion. And the engagement metrics underpinning these numbers are equally stark, with 27.5 million total users, split between 15.7 million in their mature Kazakhstan market and 11.8 million newly acquired in Turkey.
Yeah, that divergence, right, between the massive top-line explosion and that bottom-line stagnation is really the central analytical puzzle of this entire report. I mean, if you are evaluating this company, you just cannot look at the consolidated numbers in a vacuum. You have to separate the highly calibrated machine operating in Kazakhstan from the complex renovation project they just purchased in Turkey.
Exactly, and for you listening, that is exactly our objective for this deep dive. But before we even touch the international expansion, we really need to establish the macro environment Kaspi navigated in its home territory. Because 2025 was, it was not a quiet year for the domestic economy.
No, not at all.
They faced a barrage of external headwinds that directly impacted these financials. Like, the specific external headwinds flagged in the presentation are pretty intense. We're looking at the smartphone regulatory impact, minimum reserve requirements, higher interest rates, and a new 10% tax on government securities revenue.
Yeah, the operating environment was undeniably hostile. First, I mean, you have to look at the localized regulatory friction, specifically that new International Mobile Equipment Identity, or IMEI, registration requirement for smartphones.
Right, let's dissect the mechanics of that. Because the government mandated that every smartphone's hardware serial number be tied to a specific citizen's identification.
Exactly. And the goal there was to curb the gray market.
Which makes sense in theory, right?
Right, but the immediate practical effect was a massive bottleneck in parallel imports. Suddenly, there was this severe shortage of new iPhones and high-end electronics entering the country.
Oh, wow.
And because smartphones are typically the highest ticket items driving e-commerce volume, this artificial supply chain freeze directly suppressed Kaspi's marketplace gross merchandise value.
So it's basically a perfect example of how a telecom regulation can just inadvertently throttle an e-commerce platform.
Precisely. And, you know, that supply chain issue was compounded by strictly financial headwinds, too. The National Bank of Kazakhstan raised minimum reserve requirements.
Which basically forces a bank to lock up a larger portion of its capital where it just cannot generate yield.
Yeah, exactly. Furthermore, to combat inflation, the central bank maintained a really punishing base interest rate of 18%.
18%. That is just massive.
It is. And then finally, the government imposed a new 10% tax on revenue derived from government securities.
Okay, which brings us to the most critical distinction in this entire report, which is the two geography structure, Kazakhstan core versus the Turkey or Hepsiburada investment thesis.
Right.
Because when you take all those localized Kazakhstan headwinds, the smartphone shortage, the reserve requirements, the 18% base rate, the new taxes, and then you factor in the drag from the newly acquired Turkish asset, the reported consolidated net income only grew 1%.
Yeah, which looks completely stagnant on the surface. But if you are an analyst trying to measure the actual health of the underlying business, you have to isolate those variables.
Right.
When you exclude those external macroeconomic headwinds, normalized net income actually grew 18% year over year.
Wait, 18%? That is a huge gap.
It's a 17 percentage point gap between reported and normalized growth, and it is analytically critical. It tells you that the core engine is still generating tremendous cash.
Right, and we see that confidence reflected directly in the balance sheet. I mean, management proposed a proposed dividend of $850 per American depositary share.
Yeah, you do not resume a dividend of that magnitude if you believe the 1% reported income reflects a structural decline.
Exactly. It signals absolute confidence in their capital allocation. And their 2026 guidance completely reinforces this.
Right. The 2026 guidance headline is approximately 20% GMV growth and approximately 15% adjusted EBITDA growth.
So they are explicitly telling the market they expect to outgrow these temporary headwinds.
Yeah, they are. And to understand how they actually plan to hit those 2026 targets, we need to examine the 5 key investment-relevant findings from the 2025 data.
Okay, let's get into those, because we really have to look at how their domestic peelers are performing, how Turkey fits in, and what that normalized income actually means.
Right.
So starting with the foundation, the payments platform. The data here points to an ecosystem that has become practically infrastructural. I mean, total payment value, or TPV, grew 19% year over year in FY 2025.
Yeah, up 19%. And they processed 6.7 billion payment transactions. 6.7 billion. That volume is just staggering. But the specific metric that really demands attention here is the rollout of Kaspi.kz.
Oh, absolutely. Kaspi.kz is their proprietary pay-by-palm biometric system.
Right.
And they launched it, and within less than 90 days, they reached 511,000 registered consumers.
500,000 people in 3 months?
Yeah. And more importantly, it achieved a 9.2% transaction penetration rate at participating merchants.
Which is wild. The speed of that adoption is what warrants analysis here. I mean, a 9.2% penetration rate for a fundamentally new payment behavior in under 90 days is highly unusual.
It is.
And the mechanism making this possible is the total vertical integration of the platform, right? Because biometrics usually fail due to point-of-sale hardware fragmentation.
Exactly. But because Kaspi operates the consumer wallet and they provide the payment terminals to the merchants, they control the entire loop.
Right.
They map the optical vein pattern of a user's palm and link it directly to their pre-funded Kaspi account. So it completely eliminates physical friction. You don't need a plastic card, you don't need to pull your phone out, you don't even need internet access at the checkout.
Yeah, your physical presence is the payment token. And for investors, this matters because reducing checkout friction directly increases transaction frequency.
Right, and in this model, frequency is everything, which leads directly to our second key insight, the marketplace platform.
Yeah, the marketplace numbers are huge. The headline is that e-commerce purchases nearly doubled, growing at 83% year over year.
83% growth for purchases. But if you look deeper into the unit economics, the take rate, which is the percentage of the transaction value Kaspi keeps as revenue, that expanded to 12.7%.
And that expansion is primarily driven by value-added services, with advertising being the most potent lever there.
Right, because advertising revenue shot up 64%.
Yeah, 64%.
Which makes structural sense. When you have an audience engaging with your app that frequently, you've captured the most valuable real estate in retail.
Exactly. Kaspi doesn't need to manufacture products or hold expensive inventory. They just provide the digital shelf space.
Right, and as the platform gets more crowded, merchants are forced to bid against each other for visibility.
Which is why that 64% jump in ad revenue is essentially pure margin. It requires almost zero incremental capital expenditure from Kaspi, which heavily supports that 12.7% take rate.
Okay, so moving to the third key insight. We have to look at how these purchases are actually being financed.
Right, the fintech platform.
Because the fintech platform demonstrated remarkable durability given the macroeconomic weather. Total finance value, or TFV, grew 13% year over year.
Yeah, 13% growth. But the interesting part is the composition of that lending. It's shifting.
How so?
The fastest growing product category wasn't consumer credit, it was merchant and micro business finance.
Oh, which is the logical next step in a mature ecosystem. When consumer penetration reaches saturation, you pivot to the supply side.
Exactly. The merchants on Kaspi's marketplace need working capital to procure the inventory to meet that 83% surge in e-commerce purchases.
Right, and Kaspi steps in to provide that liquidity. So the average net loan portfolio grew 31%.
Now, think about that. Any investor looking at a 31% expansion of an average net loan portfolio in an environment where the central bank base rate is sitting at 18% is going to immediately look for systemic default risk.
Yeah, 100%.
Yeah.
Because high interest rates typically just crush consumer lenders. The assumption is the cost of funding goes up, margins compress, and default rates spike as borrowers buckle under inflation.
Right, but the data completely contradicts that assumption here. Kaspi's cost of risk remained entirely stable at 2.1%.
Stable at 2.1% against an 18% base rate. That's incredible.
It is, and that stability is the direct result of their data architecture. Traditional banks underwrite loans by looking at a static credit score.
Right.
Kaspi originates loans super fast because they are observing the live cash flows of both the consumer and the merchant.
Yeah, they know exactly how much the merchant is selling today, and they know exactly what the consumer is buying.
Exactly. That proprietary visibility allows them to maintain a 2.1% cost of risk even when the macro environment is deteriorating.
Okay, so we have this ecosystem in Kazakhstan where the payments layer removes friction, the marketplace captures the commerce, and fintech finances it all with a stable 2.1% risk profile. But it's an ecosystem bound by geography.
Yeah, they have 15.7 million users in a country with a total population around 20 million. The domestic growth runway is mathematically finite.
Which brings us to the fourth key insight, the Turkish expansion. The two geographies have to be treated entirely separately here.
Absolutely. The Turkish expansion is the ultimate pivot.
So let's unpack the engagement gap between Hepsiburada and Kaspi.kz, because that is the central value creation thesis.
Right. Kaspi acquired this controlling stake in Hepsiburada, which instantly added 11.8 million active consumers to their consolidated metrics. But Hepsiburada currently operates at a loss.
Right, and the strategic mandate for the next year is managing Hepsiburada toward EBITDA break-even.
Exactly, and the entire thesis boils down to this engagement gap data. The presentation reveals that the average Hepsiburada consumer makes 6.7 purchases per year.
Okay, 6.7 in Turkey.
Right, but the average Kaspi consumer in Kazakhstan makes 24.8 purchases per year.
Wow, 6.7 versus 24.8.
Yeah, so the value creation strategy is entirely predicated on closing that gap. They aren't just buying an e-commerce website, they are buying a massive dormant user base and installing the Kaspi super app machinery underneath it.
Right, because right now, those 11.8 million Turkish consumers view Hepsiburada strictly as a digital catalog to buy goods occasionally.
Exactly. Kaspi's objective is to rewire that behavior so they use it daily.
Which brings us perfectly to the fifth and final key insight, which we touched on earlier, but it is so important it needs its own spotlight. The consolidated net income.
Right, the plus 1% year-over-year reported versus the plus 18% normalized, excluding external headwinds.
Yeah, because when you strip out the drag from Hepsiburada and you remove the localized Kazakhstan headwinds, the smartphone supply chain freeze, reserve requirements, the 18% interest rate, and the new 10% tax on government securities, the underlying normalized net income grew by 18%.
And that distinction is analytically critical for investors.
It really is.
The 1% figure represents the friction of transition and macro shocks. The 18% figure represents the actual structural efficiency of the core business model.
Okay, so let's crystallize what this actually implies across the different investor profiles evaluating Kaspi today, because the implications are very different depending on what kind of investor you are.
Right. Let's start with equity investors.
Yeah. If you are an equity investor, the primary exercise here is valuation modeling. You have to decide how heavily you weigh that 18% normalized growth rate against the 1% reported rate.
Exactly. If you believe the macroeconomic headwinds are temporary, that normalized growth rate suggests the core platform retains significant pricing power and operating leverage.
Okay, what about long-term institutional holders?
For them, the focus should really be on capital allocation priorities. The resumption of the KZT 850 per ADS dividend, combined with the 2026 guidance of approximately 15% adjusted EBITDA growth.
Right. Those data points signal that management views the balance sheet as resilient enough to aggressively return capital while simultaneously funding a massive international integration.
Exactly. Now, if you are an investor specifically evaluating the Turkey thesis, your entire model hinges on that engagement gap data.
6.7 Turkish purchases versus the 24.8 Kazakh purchases.
Right. That delta outlines the addressable upside and the timeline to profitability. If Kaspi can replicate their infrastructure and push Turkish engagement even halfway to the domestic baseline, Hepsiburada hits EBITDA break-even much faster.
Okay, and finally, for risk-focused analysts, what's the takeaway there?
For risk analysts, the external headwinds show exactly where the 2026 sensitivity lies. The platform proved it could maintain a stable 2.1% cost of risk against an 18% interest rate. But higher minimum reserve requirements or any further smartphone registration bottlenecks, those are the things that will continue to test the elasticity of their profit margins.
Which perfectly transitions us into the specific risks and execution dependencies investors should monitor over the next 12 months, drawn directly from this presentation.
Yeah, there are a few major ones to watch.
I mean, first, you have to track the consumer adoption metrics for Kaspi Aliquine, because if that biometric payment habit hardens, the payments moat just deepens significantly.
Absolutely. Second, you have to watch the regulatory environment surrounding parallel imports. Any easing of the IMEI registration process will act as an immediate catalyst for high-ticket marketplace GMV.
Right, getting those iPhones back flowing into the country.
Exactly. And finally, you really have to scrutinize the timeline for integrating the Turkish assets, because the banking license is the linchpin for deploying their fintech products abroad.
So looking ahead, the next 12 months will really test Kaspi's investment case, specifically that Turkey engagement trajectory.
Right. The single most important metric to watch is that engagement rate for Hepsiburada users. That's the whole ballgame.
Yeah, and we also need to watch if their e-commerce GMV successfully reaches their target of approximately 60% of total GMV, because that shift will definitively prove whether the marketplace has evolved from a supplementary service into the dominant driver of the ecosystem.
The execution risk is substantial, but the blueprint is clearly defined.
It really is. Subscribe to Deep Dive Central Asia for more analysis on emerging markets and investment trends shaping the region.